We will just jump right in, and let's invite Mr. Rajendra Theagarajah, the session chair of today, and we will be focusing on the topic shifts in the banking system, LIBOR and others. Mr. Theagarajah is a member of the ABA Advisory Council and former ABA chairman.
This session is a very interesting session. The topic itself has been in the discussion of the ABA agenda for a couple of years now in terms of the shift in LIBOR. But I guess today we have two very eminent speakers with different backgrounds who will share their insights into how this shift has so far been progressing and perhaps deliberate on some of the challenges also in this particular shift.
Good afternoon to everybody from Hong Kong. Thank you again to the ABA for organizing this event. Andrew and I will share the panel today, and we agreed basically on two things. One, I will start with a more general update on our topic and then talk a bit about the bond and the derivative side, and Andrew then will focus on what impact the shift from LIBOR to a new RFRs has in the syndicated loan market. That's one thing. The other thing, this is one of the last panels of this this conference. It's Friday afternoon, and Andrew and I, we both agreed to keep our presentations to 20 minutes max, probably even less. So we won't keep you too long. Plus, this afternoon, the Hong Kong Rugby 7 started, so Andrew and I have somewhere to be later. So this is the 5th ABA presentation we're doing on this topic. If you need to refresh your memory on some of the basics or how we got to where we are now, you can refer to my previous presentations. Today really is just an update on what has happened since we spoke last, and that was, I think, in late August last year. So just quick look again at the base slide here. These are the 5 major alternative reference rates we have now. They also referred to now in general as risk-free rates, though of course nothing is ever 100% risk-free. You probably all are familiar with the key features here. The major development here has been in terms of forward term rates, and we'll speak about that in more detail in a minute. I put up here the view of the old world versus the new world. You can see that of the old world benchmarks, most of them, I faded them into gray, so they are gone and probably will soon be forgotten. The only one that is still being kept alive is the US dollar LIBOR for overnight, 1, 3, 6, and 12 month. But also the days of this benchmark are numbered. As you know, that will cease to exist on 30th of June next year, so less than 8 months to go. We all will have to get used to, already have got used to the new benchmarks, as you see in what I termed the new world risk-free rates. They all are available on overnight basis, but there are quite some differences in availability when it comes to forward-looking term rates or backward-looking compounded rates. I work for European banks, so for us, of course, the development in the euro is important, though for most banks in Asia, that probably will be less important. So just a quick note here. There's no definite end date yet for Euribor. It's still in use parallel to the new ESTR benchmark. We expect Euribor to exist for at least another 3 years, and we expect its replacement when it comes to be a statutory rate provided by the ECB. We also expect the change to whatever alternative risk-free rate we will have then to be governed by very strict consumer protection rules in the EU. In terms of market adoption, there has been quite some development since we looked at that last. The adoption is progressing, of course, also because it's not a choice, it's a must, because you have to switch to the new benchmarks now that the old ones are no longer published. In the US dollar cash product space, less than 20% of the floating rate notes that are outstanding now are referenced to LIBOR, and most of those actually will mature prior to the LIBOR end date in June next year. But we still will have around $5 trillion of cash products outstanding after that date. And these products, of course, will have to be dealt with through fallback language and transition to our RFR. Again, we'll talk about that in a minute. So these are the slides I talked about. So we're here now on the market adoption. On the derivative side, SOFR futures and swap volumes have surpassed LIBOR-pegged volumes. If you look at euro-dollar futures as the most widely traded interest rate derivatives, trading volumes in 3-month futures referencing SOFR are now more than 2.5 times that of euro dollars. That compares to, I think, maybe 10 or 20% as recent as the beginning of this year. So a very large and very quick adoption. In terms of outstanding risk, however, there still is some way to go. Open interest, that's the number of contracts which traders have in open positions, is still led by euro-dollar futures. That's not really surprising because euro-dollars have been around for much longer, and they still are being used to hedge exposure on existing LIBOR positions. Post June 30th, 2023, there will be around $70 trillion of these contracts still outstanding, but their switch to an ARR will be much easier than that for the cash products, because all derivatives follow the universally agreed Erste protocol. So again, here the switch is pretty predetermined and will be easier to do than for most of the cash products. If you want to follow the adoption rate in the derivatives market, you can check the Erste Clarus adoption indicator. This is updated every month just to illustrate what has happened here in the space of 1 year. These are the numbers on the left side for September last year and on the right side for September this year. The scale of the two graphs at the bottom has been changed. In 21, it is from 0 to 25%, whereas in 22, it's from 0 to 60%. So a very large increase in the RFR adoption, as just mentioned. If you go to Bloomberg and search for SOFR issues of Asian banks, you will find now almost 800 such issues. I just listed some of them here. Most of the issuers are the New York branches of the banks, and among the Asian banks, the larger Japanese, Australian and Korean banks have been the most prolific issuers here. I listed 4 points which we can discuss about a bit now, or which we should look at a bit more closer. One is as I mentioned before, is SOFR term rates. The CME term SOFR has become the index of choice for loan banks, and I think Andrew will talk about that a bit in a bit more detail later. From a capital markets bank point of view, the issue is that the ARRC recommends forward-looking term rates in general for specific use cases only, and has restricted the use of term SOFR derivatives practically to very few occasions, i.e. to end user loan hedging only. What we see now in the market is that SOFR term rates are being used more and more in capital markets cash products outside of the strict ARRC definition. That creates quite a number of issues. The main issue, of course, is the one-sided nature of the flow. The borrowers hedge their loans by paying fixed against term SOFR, but most banks, most lender banks use overnight SOFR to hedge their term SOFR loan exposure, simply because there's still a lack of liquidity in term SOFR swaps. I mean, term SOFR derivatives currently account for only 1% of the total notional of SOFR derivatives, which is around $12 trillion US. The rest is all linked to overnight SOFR. So very few or very bad liquidity in term SOFR derivatives. That creates quite a growing pool of term versus overnight SOFR basis risk, which the banks at the moment tend to warehouse. Of course, you can manage that risk, but essentially basis risk is unhedgeable. Another issue is that term SOFR swaps are not yet cleared by any central counterparty clearinghouse like the LCH or CME. So this creates increased capital requirements for many banks due to the bilateral exposure nature if you do not go through a CCP. Though there may be some change coming here, the CFTC and ISTA are discussing about clearing SOFR swaps. I think Andrew also will take that up in his presentation, but the FCA currently is collecting comments on synthetic US dollar LIBOR. It could help as a temporary fallback or smooth the transition of legacy LIBOR contracts to the ultimate fallback rate, especially for bonds not under US law, as they are not in scope of the LIBOR Act. Synthetic LIBOR quotes are published for Japanese yen and for British pounds, but of course not on representative basis, which would be the same case for any US dollar synthetic LIBOR. It can't be used for new business, and there's no certainty for how long the FCE would publish a synthetic LIBOR. They will actually stop publication of the yen LIBOR by the end of this year, and the British pound LIBOR synthetic version will be stopped, I think, in March next year. There also may be some complications with the synthetic LIBOR for contracts under US law, depending on the contract language. In that regard, I have another slide for you. So the easiest for a transition from LIBOR to a new ARR is if your contract includes a pre-cessation trigger and a hardwired fallback to a specific rate or the ARRC recommended rate. You basically just follow that transition process to that rate, and there should not be any big discussion between the contract parties. It is a bit more tricky for contracts where there is no defined pre-cessation trigger, no hardwired fallback, and then it also depends if these contracts are under US law or non-US law. I listed here the different possibilities for you. You can go through them, and if you have any questions, I'll be happy to answer them. The panel program included a checklist for banks, so I included this shortened one. We had one also in the previous presentations. I hope none of you needs this anymore, because you should have gone through these points quite some time ago. So maybe just as a reminder to make sure all major areas are covered here. Again, this is updated from the previous presentation, a page with, I think, useful links where you can look up more details. And that actually already brings me to the end of my presentation, and I would hand over to Andrew.
So my name is Andrew Ferguson. I'm the Chief Executive at APLMA. Our mission as an independent, not-for-profit representative of the loan market is to develop and hopefully develop, improve and increase liquidity in the primary and secondary loan markets in APAC. We have 365 members, institutional members across Asia Pacific in 16 countries and about 16,000 people on our mailing list. Now I will follow Oliver's lead. I will try and be very short. I'm aware it's Friday afternoon and the Rugby Sevens has already started. So I'll do my very best to be short and to the point. LIBOR transition has been with us for more than 10 years. Since the LIBOR scandal, the manipulation scandal came to light in 2012 and was probably going on before that. It's been a very, very long road since then. There's been a lot of interventions from the Financial Stability Board, IOSCO, the Fed, the Bank of England, the Financial Conduct Authority in the UK, the Bank of England, Hong Kong Monetary Authority, and you name it, every regulatory authority in the world, along with many different working groups. So it has been a long and winding road, but we are, I think, in the final straight. We're in the final furlong. And in some respects, we may still have one or two jumps still to go over, but we are almost at the end. LIBOR transition, where are we now? Because it's been a long road and we're almost at the end of it. APLMA has been playing an important role, and I'll try and explain what we've been doing. I'll quickly touch on what remains to be done. I will just be addressing the loan markets, specifically the syndicated loan markets. And at the end, I'll perhaps give my own comments about what banks should be doing now, in our opinion. LIBOR essentially disappeared in the new issue, the new syndicated loan market at the end of last year, following very clear guidance from the regulators, the Bank of England, the Fed, etc. Newly originated deals, therefore, since the 1st of January this year, must employ the RFRs, SOFR or SONIA, or one of the new 5 RFRs, which have been developed and socialized, as Oliver was saying, over the last few years. I think it's fair to say that most of the new RFRs are now very much better understood, as are the reasons why we need to transition away from LIBOR. That's to say, to use benchmarks that are really underpinned by deep, liquid, and transparent markets and comply with IOSCO principles. But RFRs are still backward looking, and they do present in the loan markets a lot of problems. They're not user friendly. And the obvious and most poignant point, which I make time and time again, is that the applicable interest rate for any interest period in a loan cannot be determined until the end of the interest period, which makes it very complicated in terms of calculation methodology and systems. And now you have to think about observation periods, day counts, and as I said, new systems which need to be implemented, installed, tested, and cost a lot of money. Now, most banks have already done that, but there are still some laggards that don't have the systems up and running yet. Now, that said, in the sterling market in the UK, SONIA has been very much adopted. It's being used in the syndicated loan market. But here in APAC, in Asia Pacific, the currency most used is the dollar. 80% of syndicated loans in Asia Pacific are dollar denominated. So it causes us something of a problem because we are stuck between the UK and the Financial Conduct Authority guidance of using compounded rates, and the US, where people really don't like compounded rates, and they want to use daily simple SOFR averages, or they want to use term SOFR, which I'm going to come to in a moment. But as I say, we are stuck in the middle, and it may well be that we're going to have a bifurcated market where we have to get used to both systems in Asia. So RFRs are backward looking, and they're not very helpful. Just one point, Asia Pacific has about 400 to $450 billion of loans outstanding, according to Bloomberg. So it's not a market that can be ignored. That's not new issues in volume terms. That's loans already out there. I'd like to just look very quickly at legacy contracts. This is the existing book of loans that are fixed on LIBOR. About nearly 12 months ago, we did a survey on how quickly were people remediating the legacy book. And more than 50% of people who responded told us that they wouldn't actually complete the remediation until next year, the first half of 2023, which is getting very late in the process. As Oliver was just saying, synthetic LIBOR is only going to be available until June next, for dollars, until June next year. This is actually slightly worrying the regulators, but actually you can understand why borrowers are pushing back. There's a lot of problem here in terms of calculation methodology in this part of the world. People don't really know whether to go the European way, the UK way, or to go with daily simple SOFR or what. So there is a degree of uncertainty. So we've got a lot of contracts, loan contracts, which have not been remediated. And there are some contracts which we call tough legacy, where there is no means of amending or changing the contract itself. Now, synthetic LIBOR was brought in to help by the Bank of England and the FCA to help manage this problem. But it is a time-limited bridge solution until RFRs completely take over. So we do have, as Oliver's already said this, dollar synthetic LIBOR until June next year, sterling until March, and I think yen disappears at the end of the year. There have been legal and legislative solutions which have been pursued in both the UK and in America and in New York. So if all else fails, the regulatory authorities can intervene. Let's look at new issues. And as I've already said, there are major issues of using compounding averaging in the new issue market. It does involve new systems, which you may have already installed, but many people have not yet. And those systems involve complex mathematical formulae. Gone are the days when you can simply calculate the interest on a loan on your simple Casio calculator. Those days have now gone. And the RFRs in the loan market create problems with conventions that we have gotten used to, including market disruption, the waterfall of fallbacks, break costs, and interest rate floors. So the loan market is trying to find a landing on all those issues, and there is clearly no landing yet. It's still in transition. And that's before we get to the subject of credit adjustment spreads, which have been addressed by ISDA and the swap derivatives world. There has been a formula presented by ISDA for the 5-year historical median approach, but that doesn't terribly work in the loan market, and borrowers are pushing back on it very hard. In the meantime, in July last year, the ARC in the US recommended that term SOFR, as created by the Chicago Mercantile Exchange, should be adopted for, as Oliver said, certain limited use cases. But interestingly, term SOFR is picking up in Asia Pacific, and more people are using it. And why is that? Because it's forward-looking, because it's effectively a plug and play that fits the existing framework of our documentation. It is IOSCO compliant. It is borrower friendly. The administrator CME, we've got CMA, I can see there, it should be CME. I apologize for the typo. The CME is a well-known administrator of all sorts of derivatives and exchange traded products. It does need a license, but that is quite straightforward. So term SOFR has been picking up very quickly in this part of the world. If you talk to anyone in the leverage market or anyone in the M&A side or private credit, they don't want to know anything else but term SOFR. They don't want to talk about credit adjustment spreads either. But why? Because it's forward-looking. It's a plug and play. They can do away with the credit adjustment spread. They normally go straight to negotiated spreads and margins. This slide was provided to us kindly by the CME group to help us understand how quickly term SOFR is being adopted in the Asia Pacific region and around the world. So 6,700 licenses issued to over 1,700 firms in 86 countries, including many of the largest banks in the world. 2.3 trillion of loans and 490 billion of derivatives issued in 2022, which now reference term SOFR. So it's no mean thing. This is something that is very important and is picking up speed. I will say quite openly that I've been a big supporter of term SOFR personally. I think it will catch on, but as I say, we may end up in APAC in the loan market with a bifurcated market where we use, some people are using compounded, perhaps because their head office is in Europe, and others will follow the American lead and use term SOFR. What have we been doing, APLMA? One of the most important things we do is produce template documentation for our 360 odd members. Last year, we produced what we called switch documents, which start out using LIBOR, but have a switch mechanic permitting the borrower to switch into one of the new RFRs. That was quite quickly overtaken by the fact that from the 1st of January, you can only use the RFRs. So we produced at the beginning of this year a daily simple SOFR document and a document that uses compounded in arrears. But most importantly, we now have a term SOFR recommended form template and a multi-currency document, which includes term SOFR. And alongside those template documents, we have guidance notes on how to use the templates. Now, this is one of the most important things for our members and why so many members are joining APLMA, because they need these documents. But we've also been very active in terms of training and education on the subject. People talk about a communications or education gap, and we're trying to close that gap. And we realize that communications are terribly important in closing the knowledge gap. I would just like to say that the photograph at the bottom center there is our Singapore conference a couple of weeks ago, September actually. We had over 600 people in person at the Marina Bay Sands. There's a lot of interest in what we're doing and in our efforts and work on term SOFR and the other RFRs. What remains to be done? It is important in this part of the world that we finally resolve the calculation methodology. Maybe we'll end up with one, maybe we'll end up with two methodologies, compounded averaging and term SOFR. It may be that we'll even have a sort of opportunity, a document that gives a borrower to choose and to swap between one and the other. That in itself will lead to, I hope, some landing on conventions. There's things like market disruption. It's very clear we don't have a landing at the moment. Our documentation committee keeps looking at this and saying, well, not yet, not yet. So you can imagine that our recommended form of template does have a few square brackets in it. At the same time, that will help us move forwards on resolving the credit adjustment spread issue. Credit adjustment spreads are supposed to cover the difference between the risk-free RFR and the old LIBOR, which included some degree of credit risk. But I say in this part of the world, a lot of people don't like credit adjustment spreads and prefer to renegotiate the margin. But that I'm talking there about the loan market. And that brings us to completing, as I was saying, the remediation of the legacy book. This, I think, is possibly the most important thing that still needs to be done. There are a lot of banks in this part of the world, not just in Hong Kong, Singapore, and Australia, but right across Asia that haven't completed the remediation of the legacy book. There are many ways of doing that remediation, whether that's by repapering, whether it's by way of amendment and restatement of a document, or whether it's a complete new refinancing. But there is a lot of work still to be done on the remediation of the legacy book in the loan markets. And people are, as I've said earlier, hanging on and waiting until next year, which isn't altogether a good thing. And many of the regulators are having a problem with it. What to do now? This is my own views, assuming that you have the systems already in place, and that's a big if. the legacy book is the next biggest thing, as I was saying. It's terribly important you create an inventory of what you've got, agree your action plan from the board downwards, and work out your priorities in terms of those tough legacy deals and how they're going to be remediated. Make sure your plans are suitably socialized across the front office, the back office, the middle office. Make sure that responsibilities are allocated. And it would be my opinion that you don't wait until the last minute, although I can see that a lot of people are waiting until next year. I would be with the regulators, don't wait until the last minute, get on and do it. So that's really sums up what I wanted to say about the loan market. So I'm going to swing it straight back to the moderator to see where we go from here.
Thank you very much, Andrew. Certainly the comments complement what Oliver shared in his opening remarks. This is now Q&A time. Let me first throw the first couple of questions using the moderator's prerogative. My first question would be to Oliver. I think in Andrew's presentation and a couple of slides, there was a mention of ARC, the ARRC. And my understanding, limited understanding, is that it is a set of recommendations which this body puts in for fallback language where there is a legacy contractual documentation which actually goes through a transition process. Could you tell me or tell the audience whether there is a legal validity for the ARC recommendations? And secondly, if so, is it only for US dollar denominated LIBOR contracts, or does it cover other currencies as well?
Yeah, maybe if you, I switched off my presentation, but if you remember the first slide with the five different, or with the five main alternative reference rates, I had listed the working group for each of these new alternative reference rates, and the ARC, obviously, which stands for Alternative Reference Rates Committee, is the working group for the US dollar, which we all know this is the most important currency in
yes.
the world, but obviously there are working groups for the other currencies, for euros, Swiss franc, British pound, and Japanese yen. If you ask me where the ARC gets its legitimate shape, why is it the legitimate body to decide on what's happening in the US dollar, I would say they derive that from being assigned by the Fed. The Fed basically tasked or set up the ARC I think back in 2014 to address or in response to recommendations and objectives set by the Financial Stability Board and the Financial Stability Oversight Council. So that, I would say, gives the ARC the backing of the Fed. And if you do business in US dollar, I think you have to accept and respect that they are the committee that makes the recommendations. And again, if you use US dollar, you're very well advised to follow these recommendations.
Thank you very much, Oliver. Just following on that, in your experience, and this I throw this to Andrew as well, have you guys seen many issuers or borrowers going for an early opt-in, i.e. switching their respective existing LIBOR obligations to a new ARR benchmark even before any mandatory or contractual deadlines?
Can I take that?
Sure. Yes, Andrew.
Certainly in the loan market, a lot of people have, a lot of borrowers and a lot of banks lending and non-bank financial institutions have already switched. I mean, there were a plethora of new loans which are all catalogued on the LMA's website last year. And increasingly people are obviously they're having to adopt the new RFRs, but some were switching last year. And that's why we in LMA put out our switch documents, so that there was there was a mechanism to switch. But a lot of people are now going straight into term SOFR or term SONIA, into SONIA. And there may be a term SONIA at some stage, of course. So the answer to the question is yes, it's already happening. So, Oliver, do you want to add to that?
Yeah, no, it's similar to what we see here, and I think it's happening more now. I think when back then when the credit adjustment spreads were set in March 21, adding the CAS to the SOFR rates back then created a rate that was much higher, I would say, than
That's right.
the LIBOR-based rate at that time in the market. So the spread differentials between US dollar LIBOR and term SOFR were much larger than what we have now. It's now, with interest rates rising, the real world rates will come much closer to what you would have as a replacement rate with the CAS. And that's why I think also it's more palatable now to a lot of borrowers or issuers to opt in early or switch early.
Thank you very much. That's very clear. We have another question. I think it's recognized that the SOFR volumes have been progressively increasing over the months and years, but it appears that many institutional investors do not really seem to embrace this new benchmark. Do either of you, it's throwing to both of you, do you share this view? And if so, what are the reasons?
Maybe I start off on that, because my bank here, we are an institutional investor, and we of course do invest in SOFR paper, largely SOFR FRNs. I have to admit we don't like it very much, but we don't have a choice, right? Why don't we like it? And again, the reasons are most of them are quite subjective. Number one, we are lazy. I started working in banking in 1987, so that's 1 year after LIBOR was created. So the older colleagues here and we have been working with or using LIBOR for more than 30 years. It was simple to use. We are kind of hardwired to think in LIBOR terms. So SOFR it's a new concept. It's more complicated to calculate, and it just, again, it's more work for us. But of course, resisting to change is not a good reason. Some more valid arguments why we're not fully embracing it yet is one, there's very little secondary markets, or relatively little secondary market liquidity yet. If you look at the debt that has been issued this year, there's about $1 trillion, I think, in corporate debt, and only 5% of that was in floaters. So the majority issuance in SOFR issues at the moment comes from banks. So if you're looking to invest in SOFR corporate debt or for the secondary market, there's not that much liquidity yet. Of course, that will change. That is developing now. Another issue is that SOFR lacks, as Andrew also mentioned, it lacks a credit component. We as an investor, we would want to have such a metric to reflect the potential insolvency risk of any issuer or borrower. So you have to separately add this in one way or the other. Another point is the SOFR issues in my capital markets area. They all use overnight SOFR only. Again, we would prefer the term SOFR, which now is used, or A, there is a term SOFR now, and B, it's used in more issues now, but it's still restricted to certain businesses. And I think the last and more important point to me is that in a SOFR issue, your coupons are based on averages over recent periods, i.e. the coupon you get is backward looking. Term LIBOR was forward looking based on expectations of the future path of interest rates or monetary policy. So that is a crucial consideration when you invest or when you try to prepare or plan your investment and position yourself for future rate moves. With SOFR issues, you just see that they are a bit slow, I would say, to benefit from rate hikes like we're seeing them now. So this is my very, very subjective view as the investor here.
Fair comment. Thank you. Andrew, would you like to add anything to that?
I'd like to add several things, if I may. I want to outdo Oliver in his how long he's been in the market, because I've been in the market for just over 50 years now. I started working in banking in 1972. And I've seen LIBOR grow from nothing to being administrated by the British Bankers Association in 1986, I think it was, maybe 85, 86. And I've lived with it like you, Oliver, and it's very hard to change. So I endorse what you're saying. I'd also make the point it's possibly the biggest change in the financial markets that's happened in the last half a century. And it has very far-reaching implications. But it is also making it's very hard to change it because it just filters into so many different types of contract. I'm only looking at the loan side of the business, and it's very difficult here in the loan business. But what I would say, going back to the conversation about term SOFR, is that here in Asia Pacific, we see a lot of our members now using term SOFR. One very major European bank, and I'm not going to mention the nationality because you'll guess exactly who it is, told me that all new loans originated by this bank in Asia Pacific will be tied to term SOFR, unless there is some kind of overriding reason why they should not be. We're hearing from the CME that is the case. It's more and more licenses are being issued. And people and borrowers particularly are pushing back on credit adjustment spreads, and it comes down to a negotiated margin. And that's again something we learned in a survey about 6 months ago, that it's a very complicated subject. Nobody really wants to talk about credit adjustment spreads, but very few people in this market are using the Erste 5-year margin. The 5-year historical median approach. It seems that borrowers push back very hard, and that was partly because of the way interest rates were moving, as Oliver was saying. So it is a big change, and I've probably lost the gist of the question now, so perhaps I'll hand it back again.
Thank you, but I think it's very encouraging to note that there is a reasonable amount of embracing of the SOFR benchmark in Asia Pacific. From a capital market perspective, the rating agency ecosystem is an inevitable ingredient. How do both of you see the rating agencies embracing this change? Do you see them welcoming it? Do you see them adapting to it? Any thoughts on that?
I think the relevance for the rating agencies is not that large in my view. I mean, it's a new benchmark we are moving to. They just will have to incorporate that in their analysis, but I think they are more, of course, looking at the credit risk of the issuer or the borrower or whoever gets the rating. I do not think that the move to SOFR will have a large impact on the credit fundamentals of most borrowers here.
Yeah, rating agencies are looking at default risk, and that's the basis of ratings. And I don't think the RFRs, and if anything, they improve the credit risk, but I don't think that they've not been at all vocal on the subject, and they don't really have a meaningful input into the practicalities of the adjustment and the transition.
Thank you very much, gentlemen. We have another question here, which is really related to bonds. Perhaps I'll direct it to both of you. Are bonds which have their last refixing date on or before the 30th of June 2023, but with coupon dates after the impacted by the transition, to fallback language?
Well, we actually just had such a case, so maybe I can answer this, and the short answer is no. The conclusion was there's no move to a RFR because the rollover is still on LIBOR basis, so there's no repricing of this instrument with a risk-free rate, and thus no transition to a risk-free rate is required.
Correct.
Thank you.
I have nothing to add.
Andrew, anything to add to that?
No, I don't. That's exactly the right answer.
Okay, thanks. Okay, this question relates to more on the lending side, the loan side, but it's open to both of you. You know, the DeFi market, the direct finance market, is something which is challenging convention and is increasingly getting into the ecosystem, financial ecosystem. Do you see any impediment in the DeFi market developing with this particular shift away from LIBOR?
Let me try and start that conversation. Is that okay, Oliver?
Sure.
I think you're referring to what I would call private credit and funds coming into the market. Yes, there is a very clear and growing involvement of private credit funds in this market in APAC, very much following what was happening in or happened in the US. We're probably following the US about 10 years behind. It's very significant, and the PE firms are very active. The sponsors, most of the banks now have divisions or people that specialize in the relationship with the sponsors and with private credit. It's interesting. We're asked the question, is this a danger or is this competition for the banks? I see it as being complementary liquidity. Anything that increases and complements liquidity is a good thing. But does it in any way impact the transition, or does the transition impact the growth of that side of the business? What we see is the private credit people are not really interested in credit adjustment spreads, for example. They're mainly in the high yield leverage market anyway. So they're talking about fairly meaty margins, lending spreads. Does the transition impact them? As far as we see, they're very fine with term SOFR. They will do an all-in margin. They won't worry about credit spreads, and they're happy to get on with it. I'm not sure that answers the question.
No, I think it's a good attempt, Pedro. Thanks. Oliver, anything you would like to add to that?
No, I mean, we as our bank here, we are not active in this market, and I think Andrew already covered all the major points for that.
Okay. Perhaps the final question, it may not specifically relate to capital markets, but it's definitely relevant to the world we live in, right? A lot of discussion on LIBOR, evolution of LIBOR, challenges with LIBOR, and the need and justification for transition, right? And I think both you gentlemen have been operating in markets which have been developed and also recently developed, where the adoption is has been fairly smooth. But we also live in a world where approximately 4 in 10 live below the poverty line, less than $5 a day of income. How do we see this shift impacting or embracing the markets which actually are confronted with poverty and income levels below the poverty line? Do you see that as a challenge, or do you think it's something we can ignore?
Honestly, when I look at a number of markets, or here in Asia, or let's say more South and Southeast Asia, a lot of the markets from my bond investor perspective actually are predominantly fixed rate markets. So the changes we have here on the floating rate side probably will have bigger impact in I think the more developed markets, whereas in the markets you allude to, what I see is mostly fixed rate issues. So of course that all will be impacted by interest rates going up, but I do not think that the switch from, or the transition from LIBOR to a new benchmark will have any let's say deteriorating or negative impact in these markets. I don't see that danger.
Good comment, good observations, Oliver. Andrew, anything to add to that?
Yeah, just, I mean, it's kind of a left field question. What I do perceive is that smaller, less developed countries around the region, which may fit into the category you just described, have been slow to adjust. They don't have to move to RFRs. I mean, if you take Australia, BBSY is not changing, and Hong Kong dollars, HIBOR is not changing. It's going to continue with, I'm talking about loan markets, but those benchmarks will continue. The Hong Kong Monetary Authority has agreed to sort of continue with HIBOR as a sensible benchmark and to be calculated in the way it's always been calculated. They don't see any manipulation risk. Malaysia, Indonesia, I mean, yes, they eventually may develop RFRs, overnight markets, and some of them have overnight markets already, and they may be slow to develop. But does it really matter if they stick with the old way of calculating the benchmark? Much like, I mean, based on the LIBOR methodology, presumably with quotations provided by participant banks. But there's no reason why they shouldn't continue to do that. But they do need to assess the manipulation risk, let's call it, or the risk of the system breaking down. But look at Singapore. I mean, not an undeveloped country by any means, but they have completely adopted compounded, all the way down to compounded averaging, SORA, all the way down to the retail sector, to the extent where the government in Singapore and the MAS is trying to educate the local population to use compounded averages, to the extent of seeing advertisements on the side of the MRT. How you persuade the man in the street, the 60-year-old granny or 70-year-old granny, that her mortgage is going to be calculated on SORA, which she doesn't understand. I don't know the answer to that. But those countries will eventually catch up, I think. Everybody understands that liquidity, transparency, and the IOSCO principles are important, and those smaller countries will catch up over time.
So I think that's promising to know that the one-size-fits-all is not just whitewashed like with a paintbrush, and that individual countries are given the choice for gradual adoption. So thanks very much for that clarification.
Thank you, Rajendra. Thank you, gentlemen, for an insightful discussion. And that ends our fourth and final session of the conference. Thank you, and have a nice rest of the day.
Thank you.
Thank you. Bye.
Bye-bye.